Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Good morning. I'm just going to be really quick and brief because I'm still eating. I want to get there before the news. So we had a move up yesterday, and now we're moving down quite strongly, pushing down against the low of the session. We could be getting some trending action again today, so I'm looking for any kind of pullback to potentially fade. E-mini has moved higher significantly, and I believe so. If I could just pull up the news here really quick. Fed fears it may have been too successful at whipping U.S. unemployment. Anyways, there is talk of a U.S.-China trade discussion, which is a lifting sentiment, so nothing too substantial. I actually would be really surprised if a deal came out of it, because they've been doing this like, what, 20 times now? But that's what's pushing us higher. So yeah, I'm definitely, it is an auction day, so I think that we could still see, particularly in the bonds, we could still see some of the action that we saw yesterday, but it also appears that we're going to be doing some downtrending, so that's good. I like some trending. Yeah. So yeah, and that's it. And we have news. Let's see here. Do we get CPI today, don't we? Let's see here. It is Thursday. CPI and unemployment claims. All right. So I'm going to go in and post the links now, and I will talk to you guys here in about 10 minutes. All right. Yeah, Lucas, the first thing Lucas says is, this looks bearish. It really does. I mean, it looks bearish for bonds. Especially with an auction coming up, you know? It's pretty, yeah. It's a pretty strong move, I would say. So I think we could get some it could run away from them, so we got to be vigilant. All right, anyways, let's eat.
Block sell.
buying 88 in the €9 again.
Minutes time now. This expected a 0.2% with year-on-year 2.8%. Core readings month-to-month 0.2% expected with 4% expected. Also be getting weekly US initial jobless claims, 210,000 expected. The new jobless claims prior of 1.707 million, and the US earnings for out of Canada will be getting the price in by. On a final note now from RBC prices firmer in August. Where we look for medical prices. Provide and
Less than 2 minutes. They are just buying the shit out of 59 Eurodollar. Just keep hitting these 1,000+ lots.
minute 9 to the bottom of the hour.
CPI is expected at 0.2%.
Yeah, Forex Factory has it at 0.3, so I think there's slight disagreement between the estimates, but that's normal. It'd be interesting if it's an outlier like the PPI was, though.
10 seconds.
5 seconds.
Okay, pretty significant pull, that's for sure. Okay, it was under expectation.
Year-on-year 2.7%, core month-to-month 0.1%, year-on-year 2.2%. Initial jobless claims 204,000 with continued
Was on par.
1.696 million. Your average weekly earnings 0.1% with Canada. New
Was
housing
it?
price index 0.1%. That was US CPI month in at
Oh
0.2%.
man, they didn't make the
Expected
CDM.
0.3. Year-on-year
Nope.
Oh, the expectation was 0.3%,
core readings
sorry.
month-to-month 0.1%.
And it came out at 0.2.
Year-on-year core at 2. Expected. Initial jobless claims coming at 4,000, 5,000. Jobless claims for the 4-week average.
Okay, well that just takes us to where we were yesterday. Well, that just takes us to where we were yesterday.
Expected. With reminder that we live link and a dial-in service for Premier listeners.
Yeah, so whoever that was buying D8 euro dollars ended up buying like 20,000 contracts. No, like 15,000 contracts. Their position's looking pretty good right now. They've traded almost 100,000 contracts just in this 5-minute interval since the 7:30. Or the weekly VWAP and the 10-year and in the 30.
I like what Alligator's saying there. The short end got squeezed, but the long end didn't really get affected that much.
Yeah, we went from flattening by a tick to now steepening by a point in the 10s, 30s. We're steepening across the board now. 5s, 10s, 5s, 30s, 10s, 30s. We're all the way back to the top of this range. Haven't tested yesterday's high, but
Business investment is fostered by the favorable financing conditions, rising corporate profitability, and solid demand. Housing investment remains robust. In addition, the expansion in global activity is expected to continue supporting euro area exports. This assessment is broadly reflected in the September 2018 ECB staff macroeconomic projections for the euro area. These projections foresee annual real GDP increasing by 2% in 2018, 1.8% in 2019, and 1.7% in 2020. Compared with the June 2018 Eurosystem staff macroeconomic projections, the outlook for real GDP growth has been revised down slightly for 2018 and 2019, mainly due to a somewhat weaker contribution from foreign demand. The risks surrounding the euro area growth outlook can still be assessed as broadly balanced. At the same time, risks relating to rising protectionism, vulnerabilities in emerging markets, and financial market volatility have gained more prominence recently. According to Eurostat's flash estimate, euro area annual HICP inflation was 2% in August 2018, down from 2.1% in July. On the basis of current futures prices for oil, annual rates of headline inflation are likely to hover around the current level for the remainder of this year. While measures of underlying inflation remain generally muted, they have been increasing from earlier lows. Domestic cost pressures are strengthening and broadening amid high levels of capacity utilization and tightening labor markets, which is pushing up wage growth. Uncertainty around the inflation outlook is receding. Looking ahead, underlying inflation is expected to pick up towards the end of the year and thereafter to increase gradually over the medium term, supported by our monetary policy measures, the continuing economic expansion, and rising
ECB
growth.
stuff.
This assessment is also broadly reflected in the September 2018 ECB staff macroeconomic projections for the euro area, which foresee annual HICP inflation at 1.7% in 2018, 19, and 20, which is unchanged from the June 2018 Eurosystem staff macroeconomic projections. Turning to the monetary
I'm frustrated because I definitely could have taken advantage of that move, but I was just very flat-footed.
2018 from 4.5 in June. Apart from some volatility in monthly flows, M3 growth is increasingly supported by bank credit creation. The narrow monetary aggregate M1 remained the main contributor to broad money growth. The recovery in the growth of loans to the private sector observed since the beginning of 2014 is proceeding. The annual growth rate of loans to non-financial corporations stood at 4.1% in July 2018, while the annual growth rate of loans to households stood at 3%, both unchanged from June. The pass-through of the monetary policy measures put in place since June 2014 continues to significantly support borrowing conditions for firms and households, access to financing, in particular for small and medium-sized enterprises, and credit flows across the euro area.
Resistance in the 10-year.
A cross-check of the outcome of the economic analysis with the signals coming from the monetary analysis confirmed that an ample degree of monetary accommodation is still necessary for the continued, sustained convergence of inflation to levels that are below but close to 2% over the medium term. In order to reap the full benefits from our monetary policy measures, other policy areas must contribute more decisively to raising the longer-term growth potential and reducing vulnerabilities. The implementation of structural reforms in euro area countries needs to be substantially stepped up to increase resilience, reduce structural unemployment, and boost euro area productivity and growth potential. Regarding fiscal policies, the broad-based expansion calls for rebuilding fiscal buffers. This is particularly important in countries where government debt is high and for which full adherence to the Stability and Growth Pact is critical for safeguarding sound fiscal positions. Likewise, the transparent and consistent implementation of the EU's fiscal and economic governance
the push is pretty strong.
To bolster the resilience of the euro area economy.
But we got to be careful. I mean, this could snap back on our interface really quickly. So we are hitting some resistance points. I'm not going to take it short, but I'm a little concerned about just buying 17.5. Really, if I had taken some of my original ones, that could have taken 130. Was a little optimistic for it to come back to 110 11 when I put in my order. So yeah.
Mr. Draghi, first question is, you've decided to reduce bond purchases from October, but you still left the ending of the program at the end of the year open or dependent on the incoming data. Could you walk us through the arguments behind that decision? Why leaving the ending of the program still open? And my second question would be, based on the forecast you've received today and the discussion that you have, would you say that the outcome in the Eurozone is already closed or close to being closed this year, or we still have to wait for that to happen in next year? Thank you.
Thank you. The answer to the second question is that we've seen growth rates now for some time above growth potential. And to the first question is basically we haven't discussed this. My reading here here we will reduce the monthly pace until the end of December, and we anticipate that, subject to incoming data confirming our medium-term inflation outlook, we will then end net purchases. I think that's the text, that's what we've discussed. We haven't elaborated on that. Let me make clear that it's when we stop.
And they're trying to make it look like it's really obviously going to go through.
The amount of accommodation will remain very significant. And through our investment policy and through our forward guidance and interest rates. Thank you.
Mr. Fellis?
Thank you. Tom Fellis from the Wall Street Journal. Your new economic forecasts suggest that inflation will hover around 1.7% for the next 2 and a bit years. Is that consistent with
Little brick setup
and the decision to phase out QE? And in relation to that, second question: shouldn't the ECB be aiming for an overshoot on inflation?
I'm sorry?
Shouldn't the ECB aim for an overshoot on inflation rather than undershoot, given that it's been below target for so long?
Thank you. The answer to the first question is yes, it's consistent. We are seeing convergence, and that's what the discussion today.
So they just did the level break and they didn't really get many stops there.
And we have confidence that this is happening, confidence based first and foremost on our monetary policy, which remains accommodative, and second, on the underlying strength of the economy, the ever-improving conditions. Number about employment, it says that 9.2 million jobs have been created in the euro area since 2013, and rising wages. So we are confident that our present monetary policy stance is consistent with our aim. Second point, our objective is an inflation rate which is below but close to 2% over the medium term. We stay with that. That's our objective.
Jones?
Jones, Financial Times. First of all, I'd like to ask about the whether or not there was any discussion or even a discussion of when you will have a discussion on the reinvestment policy. I'd also be interested in your personal view of this idea floating around of an Operation Twist style operation that could perhaps be tailored to the needs of specific Eurozone member states. Thank you.
Well, thank you. No, frankly, we haven't discussed, and we haven't, as I said last time, we haven't even discussed when we are going to discuss it. Now, having said that, we have 2 meetings before year end. So we either discuss next time or in December. And so it's just a matter of we'll take this decision in the coming days, really. And it was going to be at the level of committees first and foremost, because it have to be prepared, properly prepared. Other than that, as you've seen from my reading, the reinvestment statement is exactly the same as before. Now, we haven't discussed either the Operation Twist or whether to reinvest in different maturities. But what I think what I said last time, and I can confirm that, and even though we haven't discussed, I believe the Governing Council would be pretty unanimous on that, is that the capital key will remain the guiding principle.
Block cell.
Okay, so at least somebody thinks that that's a stopping point.
From Sole 24 Ore. So even if it looks open-ended, let's say that QE is about to end, and there is growing confusion in Italy, I think, about what QE has been really all about.
Pretty big sell there.
Some people think that the QE
3K lot at 17, followed by some other big lots at 16.5.
Will mean that Italy in particular be abandoned, left alone to fight against the attacks of speculators. So I don't know whether you want to comment
the tax of speculators.
Thank you. It's actually
you hear that, boys? We're a tax.
The mandate
they're
of the
selling Eurodollars
ECB
now.
is price stability in the medium term.
Somebody's selling 91.5.
And
the,
QE has been one of the tools we used to pursue this task. In the past, the ECB was asked, why are we keeping, for example, interest rates negative and we are depriving the savers from their income? Or why are we hurting insurance companies, banks through low interest rates? As I always answered, it's not the mandate of the ECB is not to protect bankers' profits or insurance companies' profits. And in this case, responding to your question, is not to ensure that government deficits would be financed under all conditions. So our task is to pursue price stability. That's what...
Berlin Handelsblatt. So you've mentioned increasing risks concerning emerging markets, currency crisis in Argentina and Turkey seem to have contagion effects on other emerging markets. How much of a threat is that for the Eurozone economy and the world economy? And my second question is, the current problems in the emerging markets seem to be related, at least partly, also to the tightening of monetary policy in the US and the withdrawal of liquidity.
What do y'all's squad have?
We also anticipate
the
to
CPI
stop
estimate
net
to be
purchases
at? Like what the
next year.
expectation was and then what the actual reading was?
Forex Factory has the estimate is 0.3.
Expect when the two main central banks
I do trade the news, and that's what they had is
liquidity.
0.3. I never realized how
Concerning the first questions, the increased uncertainties in some emerging markets is certainly one factor that adds to the general uncertainty in world markets. But having said that, so far the spillovers from Turkey and Argentina,
I don't think in this case it was necessarily that they missed expectations. I think a lot of it had to do with all of those orders going off into it, right? Like there's so many people selling and stuff. So I think that a lot of people got squeezed out there.
High inflation, high budget deficits.
But
the currency, but other market countries that have better fundamentals have not been affected. I think that's a key. That's one key consideration, which is also, in a sense, is seen from the perspective of the Eurozone is reassuring. So far, we've seen quite limited contagion, at least in the aggregate. Now, of course, we can have individual situations of significant exposure to local crisis, and that's different.
I was definitely looking for shorts just based off of the overnight action, and when it came up, I was a little flat-footed and couldn't find a spot to buy it.
Situation of emerging markets, which, by the way, doesn't include only Argentina and Turkey, but big changes in China of a different kind, however, not financial stability related. The second source of uncertainty is indeed the potential. We haven't seen much yet, so
I was just going to try to scout
it's
for
one of the risks we're looking at. We're certainly monitoring the potential financial markets volatility generated by changes, gradual as measured pace, as you know, changes in monetary policy in the main jurisdictions. This is one potential risk of enhanced financial volatility. And we're also monitoring that. But certainly, the major source of uncertainty that we see in global output comes from the rise in protectionism, and that is the major source of uncertainty, which, by the way, is reflected in the current macroeconomic projections only to the extent of the measures that have been implemented already. So the current projections do not reflect measures that have been announced, measures that have been threatened. And clearly there we have to look at basically three factors that may make this uncertainty more severe. One is clearly we have to assess the extent of an escalation. That is one factor that certainly we have to look at. And the so-called confidence effects. Besides the effects on prices and tariffs and quotas and volumes traded and so on, what is going to be the effect on general confidence of an extended trade war? That is certainly a second factor. The third factor, which makes any assessment quite difficult, is to assess what are the implications on the international value chain of changes in tariffs of a significant and broad and significant proportion.
Weisbach?
Annette Weisbach with CNBC. I would like to ask you what you think about the remarks by the head of the European Commission, Mr. Juncker, in his State of the Union address. He was calling for the euro to be an international reserve currency, which could potentially rival also the US dollar. Would you support that as the ECB, as an institution? And then let me bring you back 10 years ago when the Lehman crisis was just happening, like the
I like that uptick, but nobody's hitting 17.5.
If you think back,
Come on.
what was the biggest challenge for you?
There we go.
And
good trade.
Also the years afterwards to fight the crisis, which started then. Thank you.
Thank you. Well, the answer to the first question is we are really interested to see what are the proposals of the Commission.
Trading economics has a good calendar.
With the Commission on defining or enhancing the international role of the euro. As you know, it's not part of our mandate, but we certainly stand ready to...
You know, I honestly think the best thing is to get on Twitter, use TweetDeck, and follow Live Squawk and Rand Squawk, and they tweet it immediately.
So I'll tell you what I would like to remember of that period of time. First of all, for us, the crisis actually started before Lehman. The first serious signs of an impending crisis actually date back to September 2007. So much so that by the end of 2007, the G7 and right after that, the G20 decide to task what was called the FSF, the Financial Stability Forum, which is the precursor of the Financial Stability Board, with a response to the crisis. And the FSF created at that time a working group across countries and produced an answer by April 2008 with 77 recommendations, most of which have been implemented and others are still in the way of being implemented. So that was the first answer. What I remember of that instance is the extraordinary effort of international cooperation at world level. In other words, even before Lehman, it was quite clear that the financial crisis was coming and it would have unprecedented proportions and was worldwide. And this is what was at the basis of this really unprecedented and international effort. I can say that since then, there hasn't been one aspect of the banking business that had not been touched by the regulators and the supervisors. All this effort was, in a sense, crowned by the agreement that was found by the Basel Committee and by the GEOS, the governors and heads of supervision in Basel at the end of last year. So it took 10 years to actually crystallize the effort, which, by the way, was already many parts of this had already been introduced in the supervisory practices and in the regulation. Now, current developments are also worth looking at. In other jurisdictions, we could sort of fear a backtracking to a world where there is less regulation. In the European Union, we don't see that danger. We don't see that danger. As a matter of fact, the banks are stronger. Just imagine, just look at this. The common equity tier 1 ratios were something like around 8%, 8.5% in 2008, now are 15.6% for the banks. The leverage ratio was 3.7% way back then, and now it's over 5%. Also, liquidity management, morale, risk management, governance have all been overhauled by the legislators, by the regulators, and by the supervisors. So, all in all, the banks are stronger today. But can we actually be, in a sense, complacent? And the answer, of course, is no, because in the meantime, a lot of this business has migrated from the banking world to non-banking world, so-called shadow banking. So the next step will be to ensure that equally strong regulation and supervision, of course, one has to take into account the differences in institutions, would also be applied to the non-banks.
Mr. Canet.
Go back to policy, if I may. Did you discuss changing your policy message to say that the balance of risk was tilted to the downside? The second question is about Italy, and it's about the fact that bond yields have risen in recent months. And how's that affecting financing conditions at large in Italy and in the periphery?
Well, the answer to the first question is no, we haven't changed. The balance of risk about growth can still be assessed as broadly balanced. At the same time, risks relating to rising protectionism, vulnerabilities in emerging markets, and financial market volatility have gained more prominence recently. So the balance of risk hasn't changed. Now, why hasn't it changed? Because we've seen that I've listed just a series of downside risks. There are also upside risks, one of which is the fiscal policies. Fiscal policies in several euro area countries are going to be probably less neutral than we had expected some time ago. That's one. But the other, much more important consideration is that we are observing an underlying strength of the economy that makes us think that the downside risk is going to be mitigated by this fact, by the, as I mentioned before, the improvement in the labor market and the rise in wages, which are the main drivers that support consumption. Private consumption is supported exactly by these two drivers primarily, and only secondarily by the increase in wealth, in household wealth. And investment is also being supported by the quite accommodative financing conditions, and even though they have tightened somewhat since the last meeting, the lending conditions to firms and households remain very, very favorable. So that was the answer. The second question was about Italy. Yeah. Well, let me say something I was about to say before when I was asked about Italy. First of all, words in the last few months have changed many times. So what we are now waiting for is facts. And the main fact is the draft budget law, and not only that, and the subsequent parliamentary discussion. And we have to see how that is. And then savers, capital markets, investors will formulate their view. Now, unfortunately, we've seen, as you said before, as you hinted before, we've seen that words have created some damage. And interest rates have gone up. And they've gone up for households, and they've gone up for firms. However, And by the way, all this, is another interesting point, all this hasn't created much of a spillover to other European countries. So it's remained pretty, at least so far, pretty much an Italian episode. Now, having said that, we have to basically be aware that the Italian Prime Minister, the Italian Minister of the Economy, the Italian Foreign Affairs Ministers have all said that Italy is going to respect the rules.
Mr. Pelli.
Pellino from Rai, Italian Television. I go back to Italy, but this problem with the spread could be a possible challenge for the global market, and then so that the European Central Bank could decide next year to take other measures to so like in the past, so that Italy doesn't go to be a contagious reason. And the other side, Mr. Moscovici said today that Italy is a problem for the European Union and for the Eurozone. What do you mean about this opinion?
Look, I answer the first question is we haven't seen any contagion yet. So the second thing is, I repeat what I said before. The ECB will stay with what the Italian Prime Minister, the Italian Minister of the Economy, and the Italian Foreign Affairs Ministers have said, namely that Italy will respect the rules.
Mr. Neubach.
I'm Neubacher, I'm with Börsenzeitung. Today there's been a recommendation by the private sector group to take the ESTA as a new euro risk-free rate. I'd like to know if the ECB is endorsing that decision. And secondly, I'm wondering about the fallback rate.
Okay, whoever is clicking that pen on the webcast needs to stop it. somebody in the ECB press conference is clicking their pen.
What will be the fallback rate? After all, need a fallback rate when they use such a systemic benchmark.
Thank you. Yeah, today, just not long ago, the private sector working group has recommended to use the euro short-term rate. That's why it's called ESTA. Euro short-term rate as an alternative free rate as replacement for Ionia that no longer meets the criteria of the EU benchmarks regulation, and we will see, and it will see its use restricted as of the January 2020. So we welcome this decision, and because also it brings the euro area closer to other jurisdictions where this issue has been addressed already. Of course, we want to state clearly that the private sector plays the dominant role in ensuring a smooth transition, but this transition has just started. There is a subgroup of the working group, led, by the way, by a former colleague of mine in the executive board, countryman, González Paramo, Mr. González Paramo, that is actually will oversee exactly the point you raised, namely what should be done to ensure the robustness of the contractual arrangements that are based on other benchmark rates, on Euribor and Ionia. So we can't say much about the future of Euribor because that depends very much on the administrator of Euribor and on the regulators, namely ESMA and FISMA. Thank you.
Mr. Jacke.
Sondern Jakish, the German television, Mr. President. I also would like to touch a more historic dimension. Your predecessor, Jean-Claude Trichet, in an interview described or expressed his concerns about the situation that we have a high volume of debts at the moment worldwide, comparing it to the situation 10 years ago. And that's also triggered the previous crisis. Do you agree with this assessment, which is quite strong, I think? And if so, are you actually also concerned that this high volume of debts, although they may be different now than in the past, may be able to trigger a new crisis? Thank you very much.
Yes, I do agree with this assessment, which is also the assessment of the IMF now has been saying for several months. The debt levels worldwide remain high, or in some parts of the world. As far as the euro area is concerned, however, things are slightly different. Not in the sense that debt is not high. Debt is high in the euro area as well. But private debt has actually gone down. And it went down, and a significant deleveraging has taken place, both in financial and non-financial parts of the economy, so that the balance sheet of both financial companies and industrial manufacturing is now much stronger than it was before. I mentioned before some of the numbers concerning banks, but the same could be said about non-financial companies. So private debt has gone down, public debt stays high. And that's why we always say that countries where public debt is high should be the first to rebuild fiscal buffers, because otherwise, if we have a new crisis, they don't have any policy space.
Luke Hyton, Market News. I have two questions, Mr. Draghi, if I may. First of all, is it conceivable that the bank could raise rates in steps of greater than 10 basis points after the end of the current forward guidance period? And secondly, is the ECB prepared to respond to any slowdown in Eurozone growth or inflation by delaying an increase in overnight lending rate to banks, rather than adjusting its other key rates or resorting to asset purchases?
I'm sorry, both questions might be in principle very interesting questions, but we haven't discussed that. So, I'm pretty sure there will be a time when we'll have to discuss these questions, but it's now premature.
Dad?
Thank you. Laurie Laird, MT Newswires. Mr. Draghi, did you discuss at all the signs of a weakening in industrial production for the end of the summer? You spoke about your optimism for the Eurozone economy. Some of the data we've seen recently may give cause for concern. And a second question, do you have any discussion at all about the fiscal uncertainty in the US presented by the upcoming midterm elections?
Yeah, well, answering the second question first, I mean, we actually didn't discuss that to any extent, other than saying that two things that I can remember of our very short discussion is that this fiscal expansion is pro-cyclical, and there are dangers that its effects could wane in 2020. So the risk there is of an increase in interest rates accompanied by a weakening of economic activity. That's, I think, the only point that was briefly discussed in various presentations that were made about the state of the world economy. On the first question is, yes, we had this drop in industrial productions, but again, this was looked at as I would say one of the signs of convergence of the economy to its steady state path. Namely, we had quite unusual strong growth last year, based also on a pretty strong, unusual export performance. Now, the external part of this growth now is getting weaker, and therefore we do expect some weakness in the domestic part as a reflection of that. At the same time, the domestic part remains resilient because of the consumption and investment performances I've hinted at before. So all in all, yes, we've taken note of that, but, and that's where really there was unanimity of the Governing Council, but the view of the Governing Council, unanimous view of the Governing Council, was that the present monetary policy stance is robust. Namely, even if there are limited changes in policy parameters due to various effects we just discussed, the policy stance doesn't change.
Yes, because Annette Wiseman didn't mention it, let me, with a few days delay, in behalf of my colleagues, wish you a happy birthday, Mr. President.
Thank you.
That was not my final word, so keep on hiding. I have two questions. Quick follow-up question on the risks. You said they are broadly balanced, but I want to know if what's the view that was shared among the whole governing council, or were some members maybe in favor of a more darker expression to take account the threats we about. And the second one on the emerging economies, the worst sign that we see is that the currency are losing value. And so this is reflected in the euro exchange rate, the traded exchange rate, which apparently reaches its highest level since 10 years. And it seems to be some topic of concerns for some members of the governing council. So is it something that you discussed today?
No, the answer to the first question was, was the assessment that risks are broadly balanced, shared by all governing council members? The answer is yes. It was shared by all. Of course, there were different nuances because countries are growing at still, by the way, the dispersion, I often mention this, this number, the dispersion in growth rates, in growth value added across the euro area is at its lowest historic. But we have to go back to the early 90s to find the same low rates of dispersion. But still, when you look forward, you certainly have countries where growth is more buoyant, countries where growth may be less buoyant, and downward revisions may be more significant. And that may well be not because of external factors, but because of endogenous facts that we haven't seen yet, really. So we have to appreciate that in the coming months. But the assessment, the overall assessment, was shared by all governors. About the emerging market countries' exchange rate effects on the euro area, we briefly touched on that in a sense when, in one specific context. When we say that the foreign demand is weaker for the euro area, and this may be due to the stronger exchange rate of the euro, we have to keep in mind that the depreciation of the Turkish lira actually accounts for much of that effect. So that was the context in which we briefly discussed that. But we have to say that really, in the aggregate, what's happening in Argentina and Turkey so far doesn't show any significant spillover, although at the level of individual institutions, one may well see significant exposures to local realities.
Mr. Di Vittorio?
Di Vittorio Lefonti. Does the European Central Bank or economic staff exclude that country in the Eurozone by the
I just want to point out here,
2019-2020
if I can,
will go into recession?
this big order at 15.5.
For your opinion of European Central Bank, the QE
And I think here in CB got them here.
Well, the answer to the first question is,
and this one is 27.
It's been used well in the sense that the intended effects of the QE.
So
I speak for the aggregate of the euro area, and this holds also for the other.
These ones. You notice where it comes. See right there. There was low. Now it's showing up one tick below that pullback.
But in terms of going back to whether countries have used it well or not, yes, I mean they used it well.
Yeah, ZF really looked like it.
Everywhere. a reduced dispersion in growth rates everywhere, an employment situation which is by and large improving almost everywhere. Now, some countries more than others.
No, above us.
Now, if your question is meant to say, shouldn't have governments taken advantage
Notice
of the
that
situation of
that
such
order
low rates
just barely showed up in
raise
ZF.
budget deficits, to restore, well, they should do it. Certainly, they should definitely do it. Within fiscal buffers, take the opportunity of low interest rates to carry out a sound economic policy with a budget which is growth friendly. And keep in mind that this is a good situation for doing.
That seems like a rather ambitious target.
Thank you, Max Schröder, Börsenzeitung. My first question is on your growth and inflation outlook. You describe your growth outlook as broadly balanced. What about the outlook for inflation? Is this also broadly balanced, or is it to the downside or to the upside? And my second question is on reinvestment. You mentioned earlier that it's also up to the committees to discuss that. Would you say that these reinvestments are just a form of the technical process? Have you today explicitly asked the committee to come up with proposals on reinvestment? Thank you.
About inflation, I said inflation is going to hover around the present level for the rest of the year, and then I gave numbers for next year in 2020.
We'd have to go much further in ZB to reach those same levels.
We project slightly,
because ZB is going to run into significant resistance around 27.
for inflation.
Notice how there's big numbers here and then it drops off.
Underlying strength of the economy and rising wages. Now, of course, nominal wage growth is higher in countries like Germany.
Then move higher though, I think.
But by and large, even though underlying inflation remains muted, by and large,
We're getting slower, so I think that we could have some slow bubble up moves or some pullbacks. But they are kind of showing some indications that they want to go further.
Inflation we given, which is the result of these two components, will reach our objective over the medium term. Was this your question? No? Oh, I'm sorry. Yeah. We don't carry the same risk analysis for inflation as we do with growth. To some extent, but not completely, to some extent, the two things are interrelated. But this assumes that lower growth translates immediately into lower inflation in the long term. Now, there have been times when this was true. There are times when this isn't true. So we have to judge there, basically. So the projections that we have on inflation reflect oil prices and all the other components of the inflation rate definition. The other question, sorry, was? Oh, the reinvestment. No, I mean, I said the committees because certainly it's simple. It's not a simple question. So it has to be worked out technically well, and then we can actually discuss the council. But there will have to be preparation to that extent.
Very much.
TV's Draghi's press conference has now ended.
Okay. So now we get the E-mini in 10 minutes. So today is the rollover in the E-mini, but I don't think they tend to switch over the first day, right? It's still pretty light. Did it show? Oh, jeez.
EU leaders will discuss next week whether to have a special Brexit summit in November. EU leaders will discuss next week.
So the E-mini got higher off of that. That's interesting. They did move higher.
TB Draghi's press conference. Region around 1-2 cable. Bit of risk. Trade back above the developments out of China. where we by 625 basis. Some see stronger again. Hearing more from the senior EU diplomat, Barnier does need a legal mandate from the state to negotiate post-Brexit relations with the EU.
Bum, bum, bum. Well, here at 17.5, you could potentially buy it. It is one tick inside of the last pivot. So if they filled you at 17.5, that would fit within the risk management side of the strategy. In terms of volume profile, it's not a super great spot to be getting long, is it? So I continue to see something that's like, they're kind of making it look like they're going to go, but some of the things that I see about the volume profile and the spot that we are makes me really nervous about going for that trade. Now maybe they do something like they fall down and they fall back to 16.5. That would be great. Then maybe we could buy 16.5. And that would be a little bit more, because it'd be below the volume profile. That would be a much better trade. Although, we probably could have, when we bought it at 16.5 before, could have just held it before. But that's okay. I think that just taking the range there was the right call. Yeah, so I couldn't really tell from watching the video, but who was freaking clicking their pen in the press conference? Was one of the ECB guys up front or something? It was driving me crazy. Just, man, control yourself for one meeting. I don't think it was Draghi. That would be really funny if it was Draghi.
Banks come under pressure, drop lowest level since Feb 20. Lowering the funding LA for Greek banks for at least €2 billion.
This is what makes trading hard, guys, is when you get a big move, it's like, wow, that's a big move. I want to be in it. But then, how do you tell when it's going to stop? We're at a spot where it could stop. They did kind of go through it. Next stop, we've got 26 in ZB. That's the next clear level I see. There's some levels here in like where these targets are at in the 10-year don't really match up with anything significant. You've kind of got this range area here. So if we're able to stay above 18.5, the market profile theory is let me pull this over. If we're able to stay above 18.5, 19, then we're likely to trade through the profile here. probably to about 23. But notice that we're coming up to it and we're possibly bouncing out of it. So I'm a little cautious because this could really flip back in our faces. As I say that, it started selling. That's interesting. So here's where I said, like, yeah, at 16.5 you could maybe buy it. And look, there's people buying it. Yeah, ZB does look ripe for a pullback. I want to see what 14 does, though, before... Wow, you want to see it all the way down here, huh? See there, they took it 17. So here's the spot. Two-point pullback isn't what I'm expecting. Yeah. Well, I want to see it come back at least 5 ticks, which it has done, right? A 6-tick pullback. Actually, it's more than that, right? It's about 1, 2, 3, 4, 5, 6. Oh, no, I'm right. It's 6. Right. Well, it was a fast move, you know. I'm noticing a kind of a trend amongst you guys, both in the YouTube chat and in the Discord, that it looks like people were just a little too afraid to click into that.
Just in this Brexit development, we will keep an eye on what exactly we have as this headline. That further helps sterling's rally against the dollar as it lifts above the 131.10.
Well, we gotta keep in mind that those 16s below us. So 16 is kind of going to be the support. And now book is starting to look normal again. Yeah. Well, it's kind of interesting. There's a lot of thickness below us in the bond. Really here too. like this whole thing, it looks like that. Oh, impenetrable wall. There's no way they'll get through this. You know what I mean? And then it'll go right through it. I'm a little cautious.
You know, saying continue preparation no deal scenario on Brexit.
I mean, the plan says that you buy that. But now that we're getting what we're getting, I'm a little worried about it. And especially because of where it stopped and stuff. It was like they breached the single print and now they're failing it hard. You got 16 and then you've got like the open like 14. I don't like trading against Tyler, but I know it still says that we should buy it at 16. Okay. Nope.
Macro. Those
See, so on that one, it ticked up, and I thought, okay, so see how it's showing that 9,000 there? Okay, so that's saying, hey, maybe you should buy it. But then when it ticks back down, they're stacking a lot. That time they stacked 5,000 on it, right? So that seller is being really insistent. So the long there at 16.5 that I was planning on doing does not make sense. In fact, on a downtick like that, you maybe could have just sold into 16, frankly. It's suspicious. It's a very suspicious, because if it really could be somebody just looking to get filled at 16. I think based on this one, you sell 16.5 and buy 16. It's too late. When you get that sort of a thing, they usually don't just go. They got to tick back and forth many times because there's too many people want to get involved. excuse me for my gross noises. I think I'm getting better, but like the snot is like super thick right now. I don't know if that means I'm dehydrated or what, but man. Family was pretty quiet today, weren't they? Okay, so now, again, I took a step, decent amount, stacked all three of them, ticked down. So, it could break down to 14. If it comes back to 14, I think I want to buy it there, but okay. So it's a little bit different here because the seller is still trying to pile on, but people are buying into it. So I would say that was not a lure. That really was somebody trying to pressure us down, but he might lose. Oh, that's a good point, Uzi, that the book flipped. We're seeing reds now in the overall. I mean, it's been negative pulling. The bids have been pulling for quite some time now, actually. It's been a little bit back and forth, but especially through in here. I'm a little cautious though, because a lot of it is just these huge orders right here. Like it's pressure. They can get it to where they want, and it could totally turn around and do something else. And I really think that a VWAP bounce would be in order here. Interesting, in the past day there's been a lot of fact checkers that have made fact checks that hurt the liberal causes. And the conservative media are kind of all going, what? I don't understand. $82.16 at 15.5. It's too much. Where are we at in ZF? Okay. 257 is the 5-year open. 14 is the 10-year open. So you might not actually get the view up. We gotta be cautious about that. I'm not seeing the the signal per se. I mean, we would have to at least have a tick up, but okay, so that time, now they're not necessarily stacking up at 15. Okay. Okay. So you can see this size now, 14.5. They've been kind of stepping out of the way the whole time, and now the actual length of the poles is actually decreasing in the 10-year. So this kind of supports our theory. Okay, so there was 5K bid at 14.5, and only 2,500 traded to get through. And now that the bid, or sorry, the offer, now the offer is stacking up again. So here's where this 14 doesn't look like it wants to jump out of the way. You kind of see a potential short in the E-mini here too, by the way. Yeah, the spot fits. They're still putting pressure on it though. We're putting pressure on it, but the people aren't selling yet.
Block sell.
Oh shit. Another block order there, 32.13 lots, 14 in the 10-year, right at the VWAP. I'm kind of looking for a VWAP bounce here. So it's seeing an iceberg that big though is not necessarily what we want to see. Because when you get remember we've been saying, when you get an iceberg that big, they have a tendency to want to pile through it. Okay, well, the stack on the offers is not quite so strong, but there's still a lot there, 14.5. I think buyers might fire back here now. Let's see. Okay, they did, but they got absorbed. And the book flipped. That's kind of interesting. Okay. Okay. So I really think when we got filled there, we probably should have scratched it and waited for it to do this, and then maybe buy it. Now that we're still in it, though, the way that I'm seeing the pressure turn here, it looks good for the trade overall. I want to see this 14.5 pull if we tick up. Okay. Now they bought into it. Oh, come on. Well, that was probably the Coinbase one. Okay. So they put a pretty good bid on it, and there was some stops. you guys doing? Does not so much about making money, but keeping what you make. But you see that tweet by John Grady the other day, and he was pointing out an interview that Top Step Trader had done, and he said he hadn't listened to the interview yet, but that the guy they interviewed he thought was really good. And the whole point of their podcast was that the way that the markets work is basically tries to prey on the way that your brain works. And so you have years and years of evolutionary history basically working against you, because we are just not designed to sit around and watch something until it gives us the exact signal that we need, and then to take it and hold it regard, you know? Oh, Uzi hasn't taken me trades. Well, it's been moving a lot, right? So, yep, so we're not wired to be traders naturally. So for me, to know that there's a really good chance that it's going to fail this and everything, it's really hard to watch it come down 8 ticks and have not taken anything from it. And then to want to buy it through all of that and not seeing the book line up quite right, you know. We've been at this now 90 minutes, and I took one trade for 2 ticks. I'm liking what I'm seeing so far, though.
It's 30-year fixed rate. That's
So the one thing I see is that this is probably more the pivot. You gotta stay vigilant. So this offer's not necessarily pulling out of the way either. You gotta roll over at least one guy first, and then maybe the other guys start going, oh, maybe this is a bad idea. We absorbed a lot there, though. I mean, oh, you trade one lot and you're kind of 76. Yeah, you got to be careful, because really the what I would recommend is that you not risk more than 1% of your portfolio on a trade. So really, for the 10-year, if you're gonna have 2 ticks risk, you know, you want to have at least 3,000 in there. And honestly, 2 ticks is awfully close, and there's always a chance that you get run through or you screw things up and you could lose 4. So really I would recommend having more like 5,000. But you know, sometimes we gotta make do with what we've got, right? Okay. Well, they're getting a lot of selling again. I'm not quite sure what's causing the flood, per se. Started trading forex with 30K.
Block
Ooh.
sell.
Okay, well, 1548, that's a lot. I mean, it's based just on...
Brexit
Hmm.
confident.
Based on price movement alone, it's within tolerance, but I really don't like seeing another iceberg in here.
Not matched by the
Ooh, wow. Yeah, I would, this is why I always recommend, like, obviously there's the emotional aspect of trading and how your brain reacts and everything when you're under pressure. There's ways to create that pressure, but there's nothing quite like when your own money is actually on the line. But you're not going to succeed with that if you don't already have a successful strategy. So, well, that probably took me out for 3, huh? Well, that sucks. They're going to push it all the way back, potentially.
US issue related sanctions statement. Do US sanctions target China and Russia? Treasury?
I don't know if it's going to give us any more opportunities today. And it's hard because I really think I still really think that we could turn around. We had a good trade. I mean, look, we did get a favorable tick out of it. It just, you know, it fell. But I think we followed our plan and everything. My plan. When I traded FX, I wanted to place dozens of trades a day. Yeah. Well, the problem with FX is that a lot of that movement is random, you know? I don't like things that, if I could pull this down here for a second. Yeah, I don't need that deleted. You know, something that kind of does this. That's nice. Okay. That's what we've done today, essentially, right? Clear trend, small pullbacks. You know, book gives you a good idea of what it's going to do. Okay. Something that does this, that's okay too. I suck at trading it, but that's okay. Right? But something that does this, I don't know. The thing though is that you get candles. If I can, is that you get candles that are literally like this in Forex, you know. And it does this, you know. That's not good because you don't know when this is coming. It's random. That's some bank is completely in control and you are at their mercy, and all you are trying to do is trying to guess when they're going to come in. And that would be Forex and Bitcoin. Both act like that. And I don't think that it's good for scalping. You have to play those different on a longer term horizon. Because that short-term trading behavior is basically completely designed to screw you over. Now we're at 12. These offers stacking up behind us just aren't letting up at all, are they? I know a dude from high school who worked on an options desk and he laughed at me when I told him I was trading Forex. Wow. You know, I have a friend that he traded Forex, and I don't know what his strategy was or anything, but he did make money from doing it. He made a couple tens of thousands doing it. Like he bought a car from doing it. But
Says I'm encouraged.
I think I mean, he never explicitly said this, but I kind of started to get the impression that, because he doesn't do it anymore, and I kind of got the impression that he felt like he had gotten lucky, and he had tried trading it, after that, and had lost significant portions of it, and he had decided that, okay, this doesn't actually work. I got lucky and I was able to cash out a lot of it, so I should just stop. So it really is a crapshoot.
Block cell.
Well, this kind of price action is extremely unusual, and I think I should consider myself lucky that I've only taken 2 trades and lost a tick. Because I thought, oh yeah, we're definitely coming back to the VWAP. But to retrace almost the entire move, man. I did okay. FX largely oscillated around the 0 line in terms of net, but when FXCM went belly up, I had to close the account and got a couple puppies, put up 7 grand in privacy fence, and bought my house, and had to start over. Oh, but you made enough to buy your house? That's great. That's the goal, I think. Are you kidding me?
From 7th, 1 million.
Something's hitting the wires. What's going on? That's it right there. I'm gonna risk it.
Block buy.
Wall Street Journal has it wrong. We are under no pressure to make a deal with China. They are under pressure to make a deal with us. Our markets are surging, theirs are collapsing. We will soon be taking in billions in tariffs and making products at home. If we meet, we meet. Oh. Okay, but now it's interesting that it did get stopped out again. That spot where I bought before, that was totally a FOMO buy because we were not in the place that it was. Where did I take it? 125? No. That wasn't a good risk reward there. It could go without us. I'm all grinding my teeth now. I think I'm frustrated. I mean, I agree with Donald Trump's tweet, generally speaking. In the short run, China gets hurt more by not meeting than the United States does. So I assume is agreeing about this. The absorption on both sides thing is really annoying. Suck. Yeah. Well, you can't just interpret every one. Mm.
seconds.
This is what, the crude inventories? Natural gas.
Russia is. That's very to Russia.
Got along at 13.
And gas gains build. Dome cabin nat gas stop. Of natural energy. Trust.
Man, this happened down to 120. Like, it's, I don't know. The market seems to be taking this tweet from Donald Trump well. You know what I mean? Like, of course there was a strong move up, but it was like only 4 ticks, really. And then it came all the way back. Well, 120 would be appropriate, so... Well, I'm super pissed that I didn't get filled at 11.5. Or 12. No, it does.
Seen it. Just that this issue.
Right, I took plus. So we're back to that 14 and 14 and a half level. It's been so important. $15 is the weekly VWAP for the 10-year.
Let's see if I can draw this for him.
get to the sell 11 billion open to $11 billion. Apple here.
No, he's right. I'm mad at it. It's okay to be mad at the market. I mean, it's not a thing, but it is kind of like I screwed the strategy over today.
Up point. Facebook down. Amazon.
Okay, I'm gonna type this. I do gotta go though in a second. Actually, I just stopped streaming. It is a nice day though, guys. Hope you did okay. I will see you tomorrow.